Good afternoon. I'm David Wessel. I'm director of the Hutchins Center on Fiscal and Monetary Policy here at Brookings. And we're really pleased and excited to be helping the Council of Economics celebrate its 70th birthday. Of course, this is the 100th anniversary of Brookings, so we got there first. And it's also particularly a pleasure and honor for me to look here at the first couple of rows and see so many distinguished people. My friend Matt Slaughter, who was a member of the Council of Economic Advisors but couldn't be here today, says that good leaders are good teachers and good teachers are good learners. And when I looked at the list of people we invited today, I reflected on just how much, as a Wall Street Journal reporter, I learned from members of the CEA who are here, going back to the days of Beryl Sprinkle and Mike Musa in the late 1980s when I came to Washington for the Wall Street Journal. And I think that's because the most successful members of the Council of Economic Advisors understood that part of their job was to try and make sure the press didn't screw it up too much. And if they could improve things at the margin, that was a contribution to the public good. And for that, I want to thank them. The Council of Economic Advisors, as we'll hear in a few minutes from Roger Porter, is an unusual institution. It was born in controversy over economic philosophy in the Truman years. Some of the tension between the members of the original council continue today. There have been tensions about whether its role is to advise the president or advocate the president's policies. I commend to you all the Chapter 7 of the Council of Economic Advisors Annual Report of the President. We have some copies of a pre-release here, which is a wonderful history of the Council of Economic Advisors, from which I learned a lot, but there was one sentence which really stopped me. Apparently, in the early 1960s, Walter Heller's Council of Economic Advisors helped argue successfully against a plan to use nuclear explosions to widen the Panama Canal. So I think that alone suggests that it's been worth the money. It's nice to know that they had dumb ideas in the 1960s, too. Bill Nordhaus once said that the job of a good CEA member was like that of a good gardener. 10% planting seeds, 90% pulling weeds. And I think we're going to talk about that today because in my observations, a lot of what the CEA does that doesn't get enough recognition is stopping bad policies from happening, not only promoting good policies. Today we're going to have 3 panels with 4 CEA veterans on each one. Each one will be moderated by a journalist or ex-journalist, me, Ruth Marcus from the Washington Post, and Alan Murray from Fortune. We asked journalists to do this because journalists are the only people in town rude enough to keep people short enough so we can have 12 economists talk and still get out of here in time for drinks. I want to make clear that we invited all the chairs of the CEA to be on panels. A lot of them are here. Some couldn't make it, so we supplemented our panels with people who are members of the CEA. I want to particularly mention Charlie Schultz, who was a chairman of the council and was for a long time at Brookings. Unfortunately, for health reasons, he couldn't be here today. Janet Yellen also can't be here. She's testifying before the Senate. I suspect she'd rather be here. But in her place, I'm really happy that we have Alice Williams, who was for 51 years, 51 years on the federal payroll, many of that at the CEA, and it's exciting to see her after she retired in 2009, but she still looks 42. One reason I'm particularly happy to do this at Brookings, I'm a relative newcomer here, but Brookings has particularly close ties to the CEA. Several CEA chairmen have been resident Brookings scholars here. Martin Bailey and Ben Bernanke are here now, of course, but also Edward Norse, Arthur Oken, Herb Stein, Charlie Schultz, Joe Stiglitz, Jason Furman. Laura Tyson was a trustee of Brookings, and Martin Feldstein is on the advisory committee of my Hutchins Center. CEA members with Brookings ties include Don Marin of the Tax Policy Center, which is a joint venture of Urban Institute and Brookings, Catherine Abraham, Alan Blinder, Mark McClellan, Robert Lawrence, Rebecca Blank, Alicia Manel, Paul Wanacott, Kermit Gordon, and Joseph Davis. And that doesn't even count all the members of the CEA who've participated in the Brookings panel on economic activity, or those like my current colleagues, Bill Gale, Ted Gare, and Louise Shaner, who were on the staff of the CEA. So we're very proud to be sponsoring this event. I'm now going to turn the podium over for a moment to Jason Furman, the current chairman and he'll come back at the end with some concluding comments, and he'll introduce Roger Porter, and we'll get underway. Thank you.
Thank you so much, especially to David Wessel, who I called a couple months ago suggesting this event. And I want to thank him in particular for not thinking particularly hard or critically when I said the event will just organize itself and he won't need to actually do anything. I want to also thank Gabe Scheffler from CEA, who's the author of that excellent chapter that all of you have, and to several of the chairs who are here and not here who contributed to it as well. One of the great things about CEA really is its bipartisan tradition. And in our conference room, we have pictures of all the former chairs. And you can't sit in that room and look up at the wall and not be, one, a little bit humbled, but two, think of yourself as part of a tradition and a history that is not purely political, not just changing from party to party, but is grounded in a strong tradition of rigorous economics. And that's what we'll hear a lot of discussion of today. The first speaker who's leading off is Roger Porter, who is here because we believe in diversity and wanted to have one speaker who hadn't been a CEA chair or member at this event today. He served for over a decade in senior economic positions in the White House, in the Ford administration, and under President Reagan, as I understand it, was the equivalent of being both the head of the National Economic Council and the head of the Domestic Policy Council today. But the other thing Roger did was help bring my wife and I together and help bring me to CEA and becoming CEA chair, and he doesn't realize the role he played in either of those. He was teaching her a class at the Kennedy School, and she was getting really excited about economic policy making and telling me all about it. I was in economics graduate school with no plans at all to be in government, to be doing public policy. And she got a job, she was my girlfriend then, she got a job in Washington. I got a cold call from Joe, to interview me for a job at CEA, and Joe's form of an interview was talking to me for half an hour straight. 25 minutes was about how the NARU was much lower than the Fed appreciated, and they really didn't need to raise rates, and there were a few other topics he threw in there. And then at the end, I think Michelle told me that I had gotten the job. And part of why I took it was I was in love with this woman, and she was going to Washington, and part of why I took it was she had told me so much that she had learned from Roger about the role that CEA played and economic policy making played. So thank you for teaching her that and for whatever you're about to share with all of us.
Well, thank you. It's a delight to join in celebrating the 70th anniversary of the Council of Economic Advisors and to see many familiar and friendly faces. 2 years after the creation of the Council of Economic Advisors in 1946, Rexford Guy Tugwell, who was one of the New Deal's most prominent enthusiasts and a very experienced Washington observer, concluded that the CEA did not possess very great survival value and that it was vulnerable to its natural enemies and possesses no great strength of its own. He viewed it as an experiment that would finally be liquidated. Well, the experiment survived. Of the more than 4 dozen entities that have been lodged at one time or another in the executive office of the president, there are only 11 which remain today. Given the nature of its roles and resources, it is interesting that the CEA has shown such resilience and staying power. This is an entity that was created by congressional initiative. The Truman administration was decidedly lukewarm to the idea. The president permitted his Treasury Secretary, Fred Vinson, publicly to argue against the creation of a new entity and instead to suggest a cabinet committee which he would chair to perform the functions of the proposed council. Well, Congress charged ahead and created a council of 3 members, a chairman, a vice chairman, and a member, all of whom had equal authority over hiring personnel and expenditures. Truman ultimately signed the legislation, who's going to veto the Employment Act of 1946, and waited about 6 months before appointing anyone. He nominated 3 individuals who did not know one another well, came from decidedly different perspectives, and who did not share a common vision of how the council would function. Well, the combination was toxic. After 3 frustrating years, Edwin Norris, the chairman, resigned. Leon Kaiserling, 25 years younger, the vice chairman, was appointed acting chairman, and 6 months later nominated as chairman. But there is little evidence that the president made much use of the council. Congressional support waned, the council's modest appropriation was reduced twice, and the first Hoover Commission recommended abolishing the council and replacing it with an Office of the Economic Advisor. The new president, Dwight Eisenhower, on the advice of his administrative assistant for domestic and economic affairs, Gabriel Hauge, invited Arthur Burns, whom he had known while serving as president of Columbia University, to serve as his economic advisor and to make recommendations on the fate of the council. Eisenhower was inclined to have Burns as his economic advisor, but said he wanted Burns's best advice. After extensive consultations on the Hill and in the administration, Burns recommended, and Eisenhower approved, reorganizing the council. Presidents had reorganization authority back in those days, and making the chairman preeminent. It was Arthur Burns, more than anyone else, who established the link of the council to academia, with a staff who came to the council for a year or 2 years in many respects, and then returned to their academic pursuits. The members, as well as the staff, were senior established economists. The list over the last 70 years is truly impressive. Staff appointments are made without reference to party affiliation, don't have to go through clearance with the White House Office of Presidential Personnel. Given the timing of presidential elections that are not linked, amazingly enough, to the academic calendar, large numbers of staff serve in administrations of different political parties. This has proven to be a great strength of the council in establishing itself as an entity of high-quality, objective, and nonpartisan analysis. It's important to remember how unique as an entity the Council of Economic Advisors remains. There's nothing quite like it in the executive branch of the U.S. government. And moreover, the CEA is a distinctively American invention that's not been replicated elsewhere. During the last 70 years, Republicans have occupied the White House for 36 years and Democrats for 34 years. They have appointed 28 chairs of the council, 14 by Republican presidents, 14 by Democratic presidents. Why has the Council of Economic Advisors survived and thrived? Well, the reasons are several and interrelated. First, it has remained small. Even as the number of issues on which it provides advice has expanded with the growth of government activity. Small organizations tend to concentrate on the things that matter most, to keep those who work there energized, busy, and motivated, and to create opportunities to build a culture of collaboration. Secondly, the CEA has wisely resisted taking on operational responsibilities, with the exception of the wage price guidelines during a brief period during the Johnson administration. A key to the CEA's success has been that it has focused on the things that it does best. Third, for the most part, is it has avoided taking a high public profile and the inevitable controversies that accompany enhanced visibility. The Brownlow Committee report, which led to the creation of the Executive Office of the President in 1939, urged that the President surround himself with individuals who have a passion for anonymity. And in eschewing a high public profile, the CEA has avoided the damage to its reputation that it suffered during the final years of the Truman administration. Fourth, it has not recruited a partisan staff. Instead, it has focused on excellence, intense commitment, and those who would bring with them fresh thinking, who would maintain a steady flow of ideas from the best work in the academic community. A former White House Chief of Staff observed approvingly to me, most of the CEA members and chairs are on sabbatical and do not provide a bureaucratic or institutionally self-serving response. Fifth, the CEA is not viewed by its administration colleagues as a threat, nor filled with individuals who are seeking other positions. Serving on the CEA is not viewed as a stepping stone. It does, however, provide visibility at the highest levels. The last three chairs of the Federal Reserve Board, Alan Greenspan, Ben Bernanke, and Janet Yellen, each previously served as CEA chairs. The CEA has benefited enormously from carefully cultivating relationships with other administration officials. Before interviewing Walter Heller, with the help of a research assistant, I went through what is called the President's Daily Diary, a log of all meetings involving the President, with who is with him and the number of minutes the meetings last. I was curious regarding with whom among his economic advisors President Kennedy spent the most time. I reported to Walter Heller a striking finding. During his second year in office, President Kennedy had spent twice as much time with Walter Heller as he did during the first year. What could explain this? Heller was fascinated with the statistic that was new to him. He explained that he barely knew President Kennedy when first appointed and was relentless in his efforts to engage the President on economic policy issues. Heller suggested the creation of what he named the Troika, the Treasury Secretary, Budget Director, and CEA Chair, and the Quadriad, those three officials plus the Chair of the Federal Reserve Board, and urged that it hold regular meetings with the President. Ultimately, Kennedy relented and came to enjoy the sessions. Another key relationship for the CEA has been the individual and entity in the White House responsible for coordinating economic policy. The central role of the CEA, as Charlie Schultz reminds us, is to serve as an advocate for economic efficiency. As CEA chair, he wisely resisted Stu Eisenstadt's urging to take an office in the West Wing and to take on the role of coordinating economic policy as well during the Carter years. For the CEA chair, the relationship with the White House Economic Office is a crucial one. Viewed from outside, it appears like a relationship that could be competitive. In reality, it is far more likely to be one where these two individuals view one another as allies and often as trusted confidants. There have been two exchanges between these offices. Laura Tyson, after serving as CEA chair, became assistant to the president and director of the National Economic Council, and more recently, Jason Furman, the current CEA chair, served immediately before his CEA appointment as deputy director of the National Economic Council. In one sense, the CEA and its chairman have one client and one audience, the president. And this represents a challenge. Not surprisingly, presidents differ markedly in their interest, appetite for, and understanding of economics. 3 presidents have majored in economics as undergraduates: Gerald Ford at Michigan, Ronald Reagan at Eureka College, and George H.W. Bush at Yale. Other presidents, like John Kennedy, were curious. Go out to the Kennedy Library and see the number of memos sent to him responding to his requests about tell me about French indicative planning, etc. At the same time, according to Walter Heller, Kennedy had a hard time keeping straight fiscal and monetary policy. Heller told me that he offered the president a helpful suggestion. The Federal Reserve was responsible for monetary policy, which begins with an M, as did the last name of its chairman, William McChesney Martin. Kennedy thanked him for the tip and managed thereafter to keep fiscal and monetary policy straight. Well, at all times, the CEA has an important role to play in helping the president to make informed decisions that accurately assess the real choices he faces, that reflect substantive reality, as well as options that are capable of being implemented efficiently and effectively. This creation of estimates requires both ability and integrity. Sometimes one must approach reality carefully. The first cabinet meeting I ever attended was Herb Stein's last. After 5.5 years as a member and chairman of the CEA, he was ready to move on. Alan Greenspan's nomination would be voted on shortly. It was an opportune time to leave. Prices were rising sharply at double-digit levels. Well, the newly sworn-in President Ford thanked him profusely for his service and concluded by offering that whenever he wanted to come back, he would be welcome. Herb, without missing a beat, graciously thanked him and said, well, if it's all the same to you, I'll just wait until this inflation thing blows over. Well, to deal with inflation, President Ford convened a summit conference. Bill Seidman, his assistant for economic policy, was put in charge of organizing and worked with the then newly appointed CEA chair, Alan Greenspan, to organize a session of 30 leading economists, most of whom had served in the government, and a majority of whom had served at the CEA. The list of invitees was carefully balanced, 15 Republicans, 15 Democrats. The session was held in the East Room of the White House, and it lasted a full morning. And then the president joined the gathering for an hour to listen to their conclusions. Arthur Okun, Lyndon Johnson's last CEA chair, was chosen to present the summary. He skillfully outlined the areas where their assessments and prescriptions differed, but also where they were in agreement. Notably, that economic regulation in transportation, energy, communication, and financial services, among others, was contributing substantially to the inflation. As much as any single event, that public agreement helped launch a regulatory reform movement that extended for more than 2 decades. In Washington, policy is always the product of many hands. Presidents now routinely refer to their economic policy team and their foreign policy team. Successful teams consist of talented players who work well together. Historically, the CEA has proven a valuable member of that team. For the most part, the CEA has maintained its credibility with the Congress, with the outside economic community, and with the President and the others who advise him on economic policy issues. The CEA's task is simple, if challenging. Focus on what it does well. Maintain its reputation for sound and objective analysis. Steer clear of operational responsibilities. Maintain a fresh flow of people and ideas from the world of academia, and provide the President with the best analysis available and its best economic judgment. It faces a major challenge. In an era of heightened partisanship, can the CEA maintain its reputation for objective analysis? Can it resist getting dragged into the web of the White House communications machine? To what extent should it play an outside role? The tension that underlay the Norse-Kiesling relationship, how much to defend and seek to advance the president's policies publicly, will always remain a challenge. The CEA has survived because it fills a special niche. It brings to bear the tools of economics in a way that has special credibility. It is not tied to a department or bureaucracy or agency or outside constituency other than economists. Life in government is not a one-way street. The CEA will thrive to the extent that it is valued. And the knowledge that it is valued needs to come from the president and those who work closely with him. The quality of any organization is measured in many ways. Among them, the ability of the people who are attracted to work there and the regard with which their work is viewed and used. Organizations succeed when they concentrate on what they do best. More is not better, better is better. The CEA is an organization that has remained modest in size, agile in its willingness and ability to address a myriad of policy issues, and determined to work hard, analyze carefully, and let the chips fall where they may. Those of us privileged to have worked closely with it invariably come to admire it greatly. I am among those who believe that its contributions are many and substantial, and that those contributions have benefited the presidents that it has served so well. Thank you very much.
Thank you very much, Roger. If I can ask Alan Greenspan, Glenn Hubbard, and Austin Goolsbee, and Alan Kruger to join me up here, we can get going. So what we decided to do was to try and have themes for each of the three panels. This first one, we're going to try and look at the role of the CEA and economists in general at moments of crisis, whether they're economic, financial, national security, or natural disasters. The second one will look more at the policy process, promoting good policies and squashing bad ones. And then the third panel will focus on, take advantage of the great insights that we have here today and focus on some current economic issues. I hope we'll have time for a couple of questions on each panel, but I want to warn you that we're not going to have a lot of time, so I apologize for that. I think what I'd like to do, if I could start with you, Glenn Hubbard. You had the, must have been an amazing experience to be chairman of the Council of Economic Advisors on 9/11. What role does an economic team play at a moment like that, and what were the months like following that?
Well, 9/11 is obviously a searing memory for all of us. I still remember seeing at a CEA staff meeting the first plane crash into the World Trade Center. I think that there are three characteristics of the CEA that really shape response to crises like 9/11. But in addition to those three, I think the first crisis response is really Alice Williams, who was the master of knowing what to do. The three that I think are permanent characteristics of the CEA are first connections. Connections to academia, connections to the private sector. The second would be the interagency process that CEA tends to have a big role in. And the third is the preparation for good ideas and the ability to kill bad ones. So for 9/11, early on, beginning that day, I think there was a lot of work on airlines, on finance, on tourism, on transportation, a lot of work jointly with the Federal Reserve in real time. I wrote an op-ed on why the stock market shouldn't drop so much the day it finally reopened. It dropped anyway, which marked me to market. That day, my discounted cash flow of the American economy was rejected by the market. On the preparation, I think the CEA quickly stepped in to work on what became a stimulus package based on work that had already been done because of the difficult economic circumstances. In terms of bad ideas, they were legion, as they always are. A number of ideas for bailing out, I would estimate, perhaps 90% of the American economy. We managed to kill off about 90% of those. But I think the CEA has all those, all those characteristics that helped it in those times.
Dr. Greenspan, you were, as Roger mentioned, at the CEA in the the very last moments of the Nixon administration and the Ford administration. Most of us don't remember crises of that time. Which are the ones that you think we should remember, and what did you learn from those that we can benefit from today?
I think the first thing we ought to learn is the fact that our forecasting capabilities require improvement. Because taking Roger's discussion a little bit further, what went on in those meetings with economists in 1974 was a concern about inflation. Looming in the immediate horizon is one of the greatest collapses in economic activity that any of us have experienced. And the thing that I found most incredible was that there was no semblance of that in the economic evaluations of individuals who talked earlier. And I remember it was a really extraordinary period because the CEA was looking at a situation in which the economy seemed to be falling apart, but we didn't know why. And unless you knew why, how you would respond was impossible to conceive of. So we puzzled and said, well, there are three possibilities. There are three possibilities. One, that it is a major inventory correction, because you had to be major in order to actually take the economy down the extent to which it was. It was a collapse in final sales, effective demand, so to speak, in general, and finally some combination of the two. How you approached the problem that we were looking at and puzzled and frightened by, how you approach that depends on what your conceptual framework as to how the economy was functioning was based. And my recollection is that what we did not have was the figures on gross domestic product, or then gross national product, which covered the periods that we needed to understand and to see whether in fact there was a buildup of inventories, to see whether in fact there was a fall away in consumer spending. And what we realized is that the data that we had were too late. In other words, the gross national product, which was what it was at those days, was really quite delayed and really a very little capability of using during the period when it really was necessary. And so what we did at the CEA at that particular point was to try to say, how do we get the data that we need? And we constructed in December 1974 a weekly gross national product series. Now, I'm sure very few of you out there remember that the Department of Commerce then actually had a series on retail sales, which of course picked up most of personal consumption expenditures. Auto sales in real time were every 10 days. So we had an idea of a significant part of what the economy was doing in real time. We had considerable data on various aspects of the economy, especially the insured unemployment system. But we did not have the really fundamental numbers that we needed. So the Council of Economic Advisors in that late month, that is December 1974, set to work to see whether it could be constructed. And indeed it was. And what was remarkable about the conclusions that came from those data, which are essentially real time, was that this was an extraordinary inventory situation, a rate of liquidation that none of us had seen previously. If that were indeed the case, then we knew what policy had to be, because inventory liquidation by its nature is limited. Inventories cannot go below zero, which means as you get down towards zero, the rate of decline falls, and basically the level of production, or GDP, moves up towards final sales. And indeed, when the two of them come together, inventory change, by definition, is zero. We therefore said to President Ford and to all of his colleagues that we believe, and this was in the early weeks of 1974, that this was an inventory recession and that it was about to end. Now, that seemed an incredible conclusion because Ford had been bombarded by everybody through the Christmas holidays and into the early days of 1974 as a do-nothing president when the world was falling apart. A very prominent politician whose name I will not remember very well, purposefully that is, said that it's already too late. The crisis is upon us, and it's hard to know how it's going to end. Well, they were all wrong. A whole brew of them throughout the Congress, throughout the political system. You would have thought the world was coming apart. We were right. The people who put together this particular weekly series saved the president from making terrible decisions. And what happened was legion to this. I've experienced this many, many times. The number of terrible problems that are going to emerge because of data such as those, and it's occurred many times since then, gets solved, and what is remarkable is the amnesia which overcomes the political system about what they were recommending or what they were observing. And this was the classic case. The economy turned around, nobody said anything. All of a sudden, the criticism disappeared without recognition of saying, we were wrong, you were right. And the next year, gross domestic product went up over 6%. Now, that is an extraordinary period of time to go through a major policy choice which the president adhered to. He didn't get quite what he wanted because the pressures to do something were there, and he did something. Fortunately, it was something which was temporary, and because the changes, the fiscal changes, were temporary, they weren't permanent, we ended up with not unreasonable. In fact, in retrospect, my judgment was we probably had, with all the changes that occurred subsequent to the president's initial initiative, were probably not bad. They did change things to the better. So that was the original history of the CEA's weekly GNP figures. It was extraordinary, credible. What we did is when it became apparent that everything had turned around and there was no longer concern, is we buried the CEA weekly GDP figures with honors. Thank you very much.
Well, thank you. And so we'll note for the record that we will acknowledge that at least that one time, economists got the forecast right. But the difference between the period you described and the period that Austin Goolsbee and Alan Kruger lived through is that they did confront something which looked pretty scary in the economy. And I want to ask each of you, Alan, you were at the Treasury before you were at CEA. Austin, you were at the CEA from the beginning of the Obama administration. What role did the CEA play at that period, and do you look at it as a success for economists, or a total success, or a limited success, or what? Austin, go first.
I mean, that was a horrible time to be at the CEA, to be in the government, and there was mixed up in the transition, so we're coming
Turn
in.
the mic. Is your mic on?
I think. Hello?
Yeah.
Yes, I believe it is. It was looking back, the GDP was shrinking minus 9% or something for the quarter. I had a colleague, economic historian, who would call and say, the president keeps saying that the president-elect says that his number one goal is going to be to prevent the next depression. I said, that is his goal. He said, it's too late. And that's what it was in 1974, all over. He said, it's too late for that. The crisis has already come. He should say he has a plan to get us out of the depression that's coming. So it was that's not the funnest time to be in the government. But, the role of the CEA in the government, I think, partly depends on what's the relationship of the makeup of CEA with the president, and where are there other economists in the government. And I think mostly for better, sometimes for worse, there were a lot of economists in the government. You had Larry at the NEC, you had great economists at Treasury, you had economists really all over the government. And one thing that feels to me like has changed for CEA over the decades, many years ago when I was an undergrad, I had my advisor, and I had a close relationship with Jim Tobin. And Jim Tobin loved to tell stories about the CEA when he was there under Kennedy. And it sounded like a lot of what the CEA's function was is they were the only economists in the government. And people would say, oh my God, what is this thing, the economy? Get the economists in here. And they would give them briefings. That was it in a world where, where Larry's the NEC chair, it's nothing like that. I think overall it was, in a good way. He would keep us on our toes, on each of the issues. I think overall, in a way, it was close to an unmitigated success for economists. Not that it was an unmitigated success the way the economy played out, but looking back, I think we're probably pretty proud of how we were grappling with things, some of which we understood and some of which only now, many years later, we're coming to terms with. And mostly the economists, and especially at CEA, they came with a commitment to evidence that was quite helpful. So if we started in on housing, the issue of there's $750 billion of negative equity. So what is going to happen? Could we write down $750 billion? Where would that come from? Or will people walk away from these houses? There was a big effort to go in the academic literature. What do we know about propensity to walk away from negative equity? Well, there were a few papers. We're going to look at that. We're going to solicit input. When it came to the auto industry rescue, Alan and I were involved in that a lot. There were a lot of just fundamental economic questions like, if Chrysler goes under, what cars will current Chrysler buyers buy? Will they buy American cars? Will they not buy cars? What are the spillovers? Questions like that are political, but I think the economists did pretty well through the crisis, trying to just bring their knowledge.
Yeah?
Well, I can tell you it was not a fun time to be at the Treasury either in 2009. And there was a certain all hands on deck, which I liked because I got to do a much wider range of things. One thing which I think makes being an economic policymaker in the government during a serious crisis different is that you are required to take actions that you ordinarily wouldn't take. And to some extent, the rules of economics get suspended in the midst of a crisis. No economic advisor would say in normal times, oh yeah, why don't we have a TARP program? That's a really good idea, let's give some money to banks. Or let's bail out failing auto company. But in the midst of a crisis, those kinds of actions make sense. And the analogy I like to use, if you're driving in a snowstorm, you drive differently. you steer into the skid, which is not sort of what your intuition is from normal driving. But the tricky thing is not all of the rules are suspended. And at a certain point, the rules are going to come back, and you don't want to do lasting harm, for example, in terms of moral hazard. And as Austin said, I think the economists during this period served the administration well, represented the profession well. Austin alluded to the HAMP and HARP programs, which is the first thing I got thrown into when I started at Treasury. We looked at the literature and said, we've got $50 billion. How are we going to solve this $1 trillion problem? And it looked like the biggest bang for the buck was to modify mortgages, and that's also the direction where private banks were going. So we poured a lot of effort into designing a mortgage modification program, and how do you get the incentives right? And we tweaked that many times over the course of the years. The Recovery Act, people criticize it for being too big, and people criticize it for being too small. I haven't heard anybody say it was just right yet. But when you add it together, and the CEA, after I left, put together a very nice report looking at all of the extensions to the Recovery Act, additional support for state and local governments, the 2 percentage point payroll tax cut, which we had twice. It was a significant stimulus. One thing I think we got wrong, and Austin and I have written about this, I was concerned that if General Motors were to fail, it would have a systemic effect. I didn't think that was the case with Chrysler. I didn't think that Fiat would be a great partner. I was wrong. The president's actions over the advice that Austin and I were preparing, I think was the right choice to rescue and restructure Chrysler. So I think, David, the balance changes between, what did you say, pulling weeds and planting seeds in the midst of a crisis. Tim Geithner always used to say when I was at Treasury, plan beats no plan. Economists are very good at knocking down plans, which has the effect of resulting in a plan which the economists didn't like because you didn't come with a particular proposal. And in the midst of a crisis, some actions are necessary. Now, I was pleased to have knocked down some plans. We were under some pressure to bail out California. I don't know if you remember this, but in June of 2009, California issued $250 million of IOUs. California was not insolvent. California's actually done quite well in spite of not having gotten a bailout. And one of the real turning points to me, for me was CIT, which was the small business lender, which had received TARP funding and was interested in additional TARP funding. And that was kind of the canary in the coal mine to me because, again, we were under some pressure, not only from the outside, but also from some members of the administration to bail out CIT a second time. Yet the system was strong enough and it survived. Then the last thing I was going to mention is, at all times, CEA and economists in the government monitor data. And I would imagine that the experience of everyone in these positions is that the data is not good enough. I remember during the H1N1 epidemic, we were worried, is this going to scare people off of shopping? And I suspect it's the case that all CEAs are pretty ingenious about using data. So one of the things we did, and I see Jim Stock and Catherine Abraham here, we were worried as we were getting to the fiscal cliff in 2012 that people might realize, oh my God, I might get hit by the AMT. And this would have been a huge tax increase on middle-class Americans. And we monitored using Google Trends, which I suspect we were the first CEA to do that, how many Americans were searching for the alternative minimum tax. And it reached kind of the level as it did around April 15th of a normal year. So one has to be creative, and I think more resources should be devoted to help economic policymakers to collect additional data. There are sources like credit card data that we don't tap enough or we do on an ad hoc basis. We should be able to do kind of flash surveys and things like that. And I think that's even more important in the midst of a crisis.
Thank you. Glenn Hubbard, what about dealing with Congress, both in a crisis and not in Congress, in a crisis? How much when you were in the White House did you do that, and was it rewarding or frustrating?
Well, I think second part's fairly easy. It's generally frustrating, although it can be rewarding. I think, obviously, to the extent that the president is asking for legislation, congressional outreach is very important. And if something is technical, economic policy, CEA, at least in my time there, was often sent to the Hill. And then, of course, there's testimony on the annual cycle with the Treasury Secretary and the Budget Director. I think congressional questions are not always the most illuminating from an economic perspective. My most frequent answer was, "Thank you, Senator. I look forward to working with your staff on that problem." But I do think that outreach to members of Congress was very important for the administration.
And Dr. Greenspan, Roger alluded to something, as did I, about the tension between being the CEA chairman and advising the president, but also being a proponent of his policies. Did you find that tension when you were there, or is that just a figment of our imagination, since we love to look for people who are in conflict?
It was something I was quite concerned about when I arrived on the scene. And instead of making me, as they ordinarily did at the time, the spokesman for the president, I was just a consultant, and I stayed back. I actually said I'd much prefer to be an economist and merely an advisor. I don't want to be a spokesman for the policies of the president, mainly because I wasn't quite sure, having just gone through wage and price controls, whether in fact I believed in what they were doing. And you don't want a spokesman who doesn't believe, because it doesn't come through. As it turned out, I can't think of any significant thing that President Ford actually implemented with which I disagreed. So I had the best of all worlds in that regard. And I think I do think it is a problem that CEA chairs have, because there's no conceivable way that they can agree with everything the administration is trying to implement. And I think over the years that the CEA chairs, and indeed the CEA overall, have done rather well in making that issue less significant. I can hope, and I assume it's probably built into the nature now, that nobody believes the CEA is other than an objective group. And with the Bureau of Labor Statistics and the Bureau of Economic Analysis are assumed to be saying what they really believe and what the facts are. And I think that is an extraordinary value for the CEA. Nobody believes, no matter who the president is, that what's coming out of the CEA is other than a straight economic analysis.
Do you all agree with that? It seems to me that the BLS and the BEA are seen as civil servants, statistical agencies, but that the CEA is seen as, if you disagree with the president, you're not going to tell us, and you're pretty much have to go through the White House communications machine before you talk, so that you are sort of seen as an advocate.
You got. I think there's some element of that. It's on.
Okay. The light doesn't go on.
Yeah, the light is. My experience was the communications shop and the political world doesn't. The first thing in their mind is not, let's have the CEA go speak for the administration. It's more of the, if you, Congress, or you, the press, are really pissed off and you want to punch someone in the face, here, punch these guys in the face. You know, they're an economist. They'll take anything. So the jobs numbers are like minus 800,000, minus 700,000. When there's a good one, the president wants to go out and talk about the jobs number. So the CEA's job is, how do you explain this really horrendously bad number that nobody wants to appear on the stage with you and be associated with this number? Or, you know, here's some policy that's not good. The only thing that saves us is there aren't that many people in the press who care what the CEA or what the economists think. So yes, you might say, I got him, I caught him in a contradiction. You know, the HARP policy is based on an assumption of what the default rates would be for people who are underwater, but that contradicts a paper that you yourself wrote. Yeah, meanwhile, everyone's left. It's just you're asking that question. And
But I think you once told me that you read a lot of the speeches that the president gave and vetted them for economic accuracy.
I'm sure that's true of all CEAs.
Yeah. And what's that like?
in the State
What do
of the
they? What
Union.
about when he wants to say something that's just about, a little bit rosier than even you can swallow as a member of the administration?
I don't like the subtext of
Yeah,
that,
he's
even
gonna-
you. But I'll let that slide.
Just imagine it's going to be
Steve Braun is here, and he will testify that this was a fact.
The way to think about this is that no matter how bad it was for you, imagine what it would be like to be Donald Trump's CEA chairman.
Okay, but so
He'll be his own.
don't get Glenn started. But the State of the Union was it 2000? It must have been 2011. We have been saying, don't get down. The U.S. remains the most productive workforce in the world. So the senior economists came in, and when they do the CEA, they send around the parts, and people kind of fact check and go through. So the senior economists come in, and they said, you've been saying that, and the president even took that, and now they put that in the State of the Union. And I said, that's great for us. And they said, no, it's not. Technically, Luxembourg has higher productivity than the U.S. has. And I said, please don't tell me you sent in an edit. They're like, we did send. Their suggested edit was the president would get up in the State of the Union and say, except for 300,000 workers in Luxembourg, we remain the highest productivity.
Can I? Yeah, please. When you're vetting the speeches, you're working a lot with the speechwriters. And they actually appreciated to know where it was they were going to get criticized, even though they ignored helpful suggestions like that on Luxembourg. I'll add one other thing, David, to the question you raised about feeling pushed out there to be a spokesman. There is a little bit of attention because CEA has so much credibility. And the communications people know that. And when they're smart, they want to preserve the credibility. There was an occasion where I said, I think this is really bad policy, and I'm happy to criticize it, but I'm not going to say it's going to cause the Earth to stop spinning, if Congress goes through with this. And you have the ability to say, I'm not going to make an argument that I don't agree with, and that was fine. There is an aspect of the job which requires communicating with the public. I had the same view Alan Greenspan had, which is that the president was my one client, and that was the joy of the job, providing economic advice to the president, and the rest kind of went with the job. In the president's view, he told me that there's going to be some communications aspect to the job. And he told me when he offered me the job that Austin Goolsbee was the best person in the whole administration on television. He said I would need media training.
Glenn, it struck me as I was thinking about framing the question that the United States has a remarkable capacity to rise when we have a crisis at hand, as 9/11, as 2008, as some of the stuff that happened during Alan Greenspan's term at the CEA and the White House demonstrate. But we don't do a very good job of addressing things, or usually, the Greenspan Social Security Commission being an exception, we don't do a very good job of addressing things that aren't yet a crisis, but will someday be if we don't do something. Do you have views on what the CEA and economists in general can do to better deliver those messages, or is that just a fact of political reality?
Well, I think it is a fact of political reality, but I think there's a lot the CEA can do. It's a matter of constantly reminding the president. So in my time, President Bush was very interested in Social Security reform. That was clearly a long-term issue, not a short-term issue. And I think sometimes you have to manufacture a crisis. So I think the Greenspan Commission was in response to a manufactured crisis having to do with cash flow deficits, even though economists would say, well, that's silly. So I think this.
I mean, that the Social Security Trust Fund was, quote, in trouble.
Correct,
Yeah.
correct. Even though the present value imbalances were always there, which is what we would say is meaningful, by manufacturing a crisis, action was taken. So I do think economists can be responsible for continuing to shine the light on the problems, because it's always the case that the CEA is sort of the who invited that kid at the party. You know, people don't really want to hear about these problems or what economists say, so it's really the CEA that has that responsibility.
Take a couple of questions, and then we'll have a break. Brendan has a mic, and there's one in the back, too. Or not? One over here, and then there's one over there. Why don't we take 2 or 3, and then we'll see where we are.
While they get one, let me ask a question. Of all places in the world, this is the one place we might be able to verify this. Jim Tobin told me that when he was at the CEA, Ken Arrow was a senior economist. And that Ken Arrow said that the thing he was most proud of in his life was not Arrow's impossibility theorem or anything like that, was that at the CEA, there was some dispute that was happening over the Panama Canal. And they proposed, did you tell the story? That they
You know more,
proposed,
yeah.
they proposed to dig a new Panama Canal by
new-
dropping an atomic bomb.
Right.
And that Arrow's job was to do the cost-benefit analysis, and that he jiggled the discount rate to get it to be a negative, and so they couldn't do it. They said it was and then he had viewed that that was his highest value-add thing of his life, and I have no way to verify that.
Arrow told me that.
He did.
But I do want to note, they are building a second Panama Canal,
but
but fortunately
not
not
with
by
nuclear
atomic
weapons,
means.
though.
Now they're using clean energy.
Okay, can you top that question? Oh, Steve.
I want to correct the Canaro story. He,
All right, so this is Steve Braun from the staff of the council.
he visited the CEA a few months ago, and I remembered you talking about that story. I asked him directly if that was true. And he said, well, not so much killing the Panama Canal, it was killing the SST that he was most proud of, which also happened during his tenure.
Michelle? So wait for the mic. Wait for the mic, okay? Because there's people in an overflow room. Because this is the only place in the world we have CEA groupies.
Yes. So this is not so much a question, but as a story, just reconfirming what Austin said, which is in 1996, I was at the Democratic Convention in Chicago with Joe Stiglitz, and we were doing various meetings. Joe had been trotted out there to talk to various delegations, and we get this call from Mike McCurry saying, we need Joe to brief the White House press corps. And I was like, really, about what? And he said, it's the second revision of the GDP. And I was like, what are you talking about? And he's like, just get down here. So Joe and I go dutifully running down there, and Joe goes out there and starts talking. Well, we discover at the time that it was the news about Dick Morris had just broken. And so they tromped Joe out there so that they didn't have to have Mike McCurry on camera during the Democratic Convention. So Joe was the biggest trooper. Joe just kept going on the GDP, and he was giving it, and people, the press corps was screaming and, saying, get him off of there. And McCurry was like, no, listen to this news. This is what's important. So, Austin, I'm just reconfirming that there oftentimes is times when people are tricked.
Okay, this gentleman here has been patient in the sweater. Well, you have a high hurdle here. Yeah. No? Okay. This is in the back. Yeah, stand up so they can see you.
So I'm wondering if the current problem that we're all dealing with is over now that we're talking about it, and that's deflation.
Anybody want to advocate for deflation?
No, I'll say one thing. No one ever asked me the inflation rate. The whole time I was at CEA and Treasury. Now, it wasn't as close to zero as it is now. But I was thinking how the job evolves over time, where that was the main concern during the Greenspan CEA.
Yeah, I would agree that people's attention, there was a time when you talked about nothing but inflation, then you talked about everything but inflation, and now it's the deflation. I think the probability of deflation in the American economy is pretty remote.
Okay, let's take this gentleman over here, and then we'll take one more, and then we're going to take a break so we can you, if you ask a question, stand up so they can see you.
Thank you. Secretary Geithner and other top economists have indicated that they did everything possible to to prevent the crisis and to bring us to bring an economic recovery. The only thing that is not surfaced is everything was done to help to bail out the banks and the economy. But what about the millions of homeowners who lost their homes? What was the big problem in helping them?
So,
I actually proposed doing that. I actually put out a plan for helping homeowners. The administration didn't do it, but one could have done a lot with homeowners, true.
So Austin or Alan, I think it's a widespread perception that you thought about doing more for homeowners, couldn't find something that you thought would work, and had to settle for less results than you would have liked.
Look, in my opinion, we can go into detail on it if you want to. It's probably not the.
Good call.
We probably don't want to go that far, but I think all of the issues that you raise, we knew about. We were talking about them. There was $750 billion of negative equity in the system, and fundamentally, Congress wasn't going to give the government wasn't going to pay $750 billion to subsidize it. You couldn't stick $750 billion of losses onto the banks at that time. That would have wiped them out. And so we were going around in a circle. What are we going to do without $750 billion? We figured we could get $50 billion from the TARP if. No, but I'm not a lawyer, but, if we kind of look, yeah, maybe that's TARP, and we figured that the best way to do that was to try to count on this wedge that people did not want to lose their homes. So even if they were underwater, if you could get their monthly payment to be something affordable, they would keep making the payment and stay in their homes. And the one notable fact about the American homeowner is their almost pathological honesty that they could have walked away. Millions of people could have walked away, and they didn't. They kept paying. And in some sense, that pathological honesty hardened the minds of some of the bankers that we would say to them, why isn't it in your interest to write down principal? And they'd say, because these people are paying, So it was a very hard problem, and I think the reason the actions weren't bigger and bolder is we didn't have $800 billion.
Just to add a little bit to that, I mean, if we did happen to have $800 billion lying around, I would have preferred to use it for infrastructure. It would have been extremely unfair and created, I think, problems down the road to bail out homeowners in many cases who were irresponsible and took on homes that they couldn't afford. The program that Austin mentioned, the HAMP program, that's what launched the Tea Party. So think about what the government reaction, what the public reaction would have been to writing checks to your brother-in-law who bought a home with the expectation that the price would always go up, or he'd just refinance later on, even though it's not a home he could necessarily afford. So I think that the money from the HAMP program could have been used differently. I would have liked to have something specific for the unemployed. But what Austin said, I think, was right, in that people didn't walk away in large numbers. I mean, obviously some had to and some did. But if the payments became affordable, it was a problem that we were able to manage through. And if we had the $750 billion, I think we would have done much more to support the economy using it more directly, spending it on infrastructure or in other ways, frankly.
Yeah, just to be clear, what I meant was, what I'd proposed was actually mass refinancing of home mortgages, so nothing like spending $800 billion. The taxpayers had already taken the risk of Fannie and Freddie, not something I would have done, but something that was done. So there would have been a chance at fairly low cost to have a mass refinancing of home mortgages, which would have been like a giant tax cut for millions of Americans.
Dr. Greenspan, you want to weigh in on this? No isn't acceptable. Oh, good. Okay, so I think we're gonna take a break. We're gonna get back here in 10 minutes. You don't have to get out of your chair because we really are going to start in 10 minutes with the second panel with Ruth Marcus. Thank you.
Good, thank you. Thanks.